We have officially reached the end of the line for the manipulators. If you are looking at the charts today, December 31st, 2025, and you see a red candle dropping silver back to the $71 range, you might think the rally is over. You might think the silver squeeze was just another flash in the pan. But if you think that, you're ignoring the most basic laws of mathematics. What we are seeing today is not a market correction. It is a desperate mathematical impossibility being forced onto a screen to hide a total physical collapse. My name is Kevin Jhon, and this is Markets in Context. We are recording this on the final trading day of 2025, a year that has changed the financial hierarchy forever. Before we get into the cold, hard numbers that prove $100 silver is not just a prediction, but a mathematical certainty, make sure you hit that subscribe button and turn on the notification bell. The banks are counting on your ignorance. They're counting on you selling your physical metal because they flashed a lower number on a digital ticker. Here, we provide the context they do not want you to have. Let's look at the scoreboard for 2025. This year, silver has absolutely decimated every other asset class. While gold posted a respectable 66% gain, silver exploded with a historic 144% to 168% return. This outperformance is not accidental. It is the beginning of a re-rating of silver as a strategic industrial asset. Yet, as we sit here on December 31st, we are witnessing an 8% plunge from the overnight highs of $83.62. The question you have to ask yourself is, did the world suddenly stop needing silver for artificial intelligence? Did the solar industry vanish overnight? Of course not. The math of demand has not changed, but the math of the paper market has been adjusted by those with the most to lose. The proof of rigging is found in CME Notice 25-393. On this final trading week of the year, the CME Group implemented its second 30% margin hike in just 7 days. It now costs $32,500 in initial margin just to hold a single silver contract. Think about the mathematical intent behind that. By raising the cost of entry by nearly 60% in a week, the exchange is intentionally pricing out retail investors and forcing smaller long positions to liquidate. This is a carbon copy of the dirty tricks used in 1980 to break the Hunt brothers. When the price gets too high for the banks to cover their short positions, they do not change their strategy. They change the rules of the game. But here is the mathematical proof that their dirty tricks are failing. Lease rates. In a normal market, the lease rate for silver, the cost to borrow physical metal, is between 0.35% and 0.5%. Today, December 31st, lease rates have spiked to an astronomical 39% annualized. Let that number sink in. If you want to borrow physical silver today, you are paying 80 times the normal rate. Why? Because there is no silver left to lease. When lease rates hit 39%, the market is screaming that it is in a state of absolute physical desperation. This is the ultimate stockout signal. You can manipulate a paper ticker to say $71.70, but you cannot fake a lease rate. The 39% spike proves that the real price is far higher than the screen price. This leads us to the clown world price gap. And while the COMEX in New York is quoting a global spot price of $71.70, the physical market in China is living in a different reality. In Shanghai, physical silver is trading at a massive premium with converted prices ranging from $76.70 to as high as $90.25, depending on the immediate availability. The benchmark price in China is hovering around 528 yuan per ounce at a 7.1 exchange rate. Mathematics tells us that in a globalized economy, an arbitrage gap of $5 to $19 should not last for more than a few minutes. Traders should be buying at $71 in New York and selling at $85 in China until the prices equalize. But they cannot. The arbitrage is broken because the physical metal is trapped. This price decoupling is the mathematical proof that the New York spot price is a localized fiction, a short bailout price, while the Chinese price represents the global floor. Now, let's talk about the industrial silver eater that makes $100 inevitable, the N-type solar cell. The report I am holding confirms that the transition to NN-type cells, TOPCon and HJT, is now the industry standard. These cells are the backbone of the green energy transition, but they have a mathematical problem. They require 20% to 50% more silver per watt than the older P-type technology. Even as the price of silver hits $80 or $90, these manufacturers cannot stop. The inelasticity of demand is the most powerful force in economics. If a solar firm needs 10 tons of silver to keep their $5 billion factory running, they will pay $100 or $120 an ounce because the alternative is a total production shutdown. We are currently heading into 2026 with a projected structural deficit that is wider than anything we saw in 2025. The global silver market has been in a deficit for 5 consecutive years, and the free float of physical metal is effectively gone. This is why the gold-silver ratio is so critical to the $100 proof. Even after the record rally of 2025, the ratio is sitting at 58 to 1. Historically, when the world realizes a metal is in a permanent deficit, that ratio collapses toward the Earth's crust ratio of 15 to 1 or 18 to 1. If gold stays at its current levels and silver simply moves to a 30 to 1 ratio, which is still conservative, silver's price mathematically must exceed $125 per ounce. The final day massacre we are seeing today is a thin liquidity event. On December 31st, most institutional desks are closed and trading volume is at its lowest point of the year. The banks chose this specific day to hike margins and dump paper contracts because it takes very little effort to move the price in a hollow market. They are trying to paint a shooting star candle on the yearly chart to scare you into believing the peak is in. But they cannot hide the fact that in less than 12 hours, the January 1st lockdown begins. As of midnight tonight, China's new export restrictions take effect. Beijing is licensing only 44 companies to move silver out of the country. This is a strategic bottleneck that will choke off 70% of the silver that big tech and the artificial intelligence revolution desperately need. When you combine a 70% supply cut with a 50% increase in industrial silver requirements per solar cell, the math for a super squeeze is complete. $100 is no longer the target, it is the launch pad. But the supply side, this iron curtain falling over China's exports, is only one half of the mathematical equation. To see why $100 is the absolute floor, we have to analyze the second half, the industrial black hole that is currently devouring the world's remaining physical silver. We're witnessing a collision of three massive technological shifts, and each one of them is more silver hungry than the last. Let's talk about the solar revolution. For years, the bears argued that thrifting, the process of using less silver per solar cell, would kill the demand. They were wrong. As of December 31st, 2025, the industry has shifted almost entirely to N-type cells, specifically TOPCon and HJT technology. These are not standard panels. To achieve higher efficiency, these cells require between 20% and 50% more silver per watt than the older technology. Despite all the talk of reduction, the sheer volume of global installations has overwhelmed any marginal savings. In 2025, we saw record installations, and every single one of those panels is a permanent vault where silver goes to die. Because recycling silver from solar panels is currently not economically viable at these prices, that metal is effectively removed from the global supply chain forever. The math here is brutal for the shorts. The solar industry has a kill zone, a mathematical limit where silver becomes too expensive to sustain profits. Our data shows that solar manufacturing profits begin to evaporate only when silver crosses $134 per ounce. Think about what that means. It means that even at $80, even at $100, the solar industry will continue to outbid every other buyer on the planet because they have no choice. This is inelastic demand. They will pay $110 an ounce because a panel without silver is just a piece of useless glass. Then we have the artificial intelligence and electric vehicle explosion. A standard internal combustion engine uses a small amount of silver, but a modern electric vehicle is a rolling silver mine. Battery electric vehicles consume significantly more silver for battery management systems and high-speed charging. And now, the artificial intelligence revolution is creating an unprecedented demand for high-performance computing hardware. These systems require connectors with ultra-low resistance, applications where silver has no substitute. Every new NVIDIA chip, every artificial intelligence server rack is hungry for physical silver. This is why Elon Musk himself has issued warnings about how high silver prices could hurt manufacturers. When the richest man in the world starts sounding the alarm on a commodity, you know the supply-demand math has reached a breaking point. This brings us to the banking war of 2026. The disparity between institutional forecasts is at an all-time high, reflecting a total loss of consensus among the elites. On one side, you have the scarcity bulls. Algorithmic models like CoinCodex are projecting silver to hit $119 by late January. Analysts like Cathari are targeting $115 per ounce by the end of 2026, citing the 70% supply chokehold from China. Even Bank of America has been forced to raise its peak targets to $65, though they remain characteristically conservative. On the other side, you have the recession bears like JP Morgan and Citi, who are still betting on a dip back to $50, but these models are fundamentally flawed because they are based on paper liquidity, not physical reality. They are ignoring the 39% lease rates. They are ignoring the negative swap rates and the backwardation that prove the system is breaking in real time. When the cost to borrow silver is 80 times the historical average, the official spot price becomes a lie. The gold-silver ratio is the final piece of the mathematical proof. Even after silver's massive 168% surge in 2025, the ratio is still sitting at 58 to 1. Historically, when the world realizes a metal is in a permanent deficit, that ratio collapses toward the Earth's crust ratio of 15 to 1 or 18 to 1. If gold stays at its current levels and silver simply moves to a 30 to 1 ratio, which would still be historically high, silver's price mathematically must exceed $125 per ounce. Some analysts are now openly calling for $200 to $400 silver based on this scarcity model. Now, we must address the black swan risks that could temporarily slow this train down. The biggest threat remains technological substitution. As silver moves toward $100, the incentive to switch to galvanic copper for solar panels becomes enormous. While copper is less conductive and more prone to oxidation, it is the only alternative if silver becomes physically unavailable. There is also the risk of a hawkish Federal Reserve or a sudden shift in trade policy that could strengthen the United States dollar and cap commodity gains. Geopolitical ties, such as Trump's potential peace hints in the Ukraine-Russia conflict, have already shown they can ease safe haven pressure in the short term. However, the operational conclusion for today, December 31st, is undeniable. The market has just survived an 8% flash crash orchestrated by the CME's margin hikes. The fact that silver held the $70 support level despite a 30% increase in margin requirements to $32,500 per contract is the ultimate sign of strength. It proves that the real money is no longer afraid of paper manipulation. The final trading day of 2025 was a thin liquidity theater used to fake a crash, but the physical data does not lie. We are heading into 2026 with a perfect storm. We have the lowest global inventories in a decade. We have a superpower, China, locking its export gates at midnight tonight. We have inelastic demand from the artificial intelligence and green energy revolutions. And we have a paper market in the West that is being exposed as a hollow shell. The $8 to $19 Shanghai premium is your roadmap. It is telling you that the real price of silver is already in the 80s and 90s, and the New York price is just a lagging indicator that is about to be forced into a violent catch-up. If the 39% lease rates continue into the first week of January, the stockout will move from a warning to a reality. Once the physical metal is gone, the price is no longer determined by a chart. It is determined by the highest bidder in a state of panic. When Apple, Tesla, and Samsung are all bidding for the same ounce of silver, $100 will look like a bargain. The window to position yourself before the global silver lockdown is effectively closed. This is a market where physical possession is everything, and paper promises are worth less than the digital ink they are printed with. My name is Kevin Huang, and this is Markets in Context. We are dedicated to bringing you the raw data and the strategic insights that the mainstream media is too afraid to touch. If you found this mathematical breakdown valuable, make sure to subscribe to the channel and turn on the notification bell so you do not miss our emergency updates as the January 1st impacts begin to ripple through the globe. The next few days will define the silver market for the next decade. Stay disciplined, trust the math, and I will see you in the next video.